Is now Keith Fitz-Gerald, principal at the Fitz-Gerald Group, joining me from Utah. Keith, good to have you on.
Thank you so much. Great to be here.
So you look at a lot of bad indicators right now for the market. The price of oil is going up again as well. The crossfire continues in the Middle East and possible escalation there. Not a great CPI report, and now discussion of raising rates as opposed to cutting them. Is this a short-term impact on the market because we've seen it drop and then bounce right back up before, or do you see something more lasting here?
Well, that's a great question, Jim, and I think it's actually more the former than the latter because this is a highly quantitative move. This is traders trying to reprice risk from a deal that they were front-running anyway, the Iranian peace deal and oil prices. So it puts the Fed between a rock and a hard place, definitely. But the underlying business case for owning many of the world's great companies continues to grow stronger by the day. And that's where smart investors have the advantage.
Let me ask you this, though, because right now, I was speaking to the governor of Alaska this morning. And, of course, Alaska is deep into the energy industry. And he said he made a point, and you know this better than me, that to date, the oil prices have been going up because of risk to supply. And he said in 2-3 weeks, because of dwindling supplies, because of all these issues with the war there, that we're getting closer to a supply shock, which he says, he warns, would mean more lasting damage, higher oil prices, and all the various carry-on effects from there. Do you share that concern that there's some point at which this becomes real pain in the energy markets and not just fleeting pain?
Well, I do. And, the issue immediately is whether the oil companies have hedged that appropriately. Do they have a global footprint? Can they draw their oil from other supply stocks that they've got around the world? What does that look like for manufacturing? So, yes, it's a real risk. But historically, it's the problem associated with a gradual shift versus a sudden shift. If it's a sudden shift, we definitely got problems. But it's not a canary in the coal mine yet, in my humble opinion.
Okay, and you heard, before we go, you heard our business reporter there make the point that now the betting is that the Fed won't just hold steady on rates, but a 68% chance of raising rates. Now, you may disagree with that, but I wonder, how would the markets react to an interest rate hike?
Well, actually, I don't disagree with that. That's been my contention from the beginning of the year, is that the Fed's going to be forced into that position sort of unwelcomely. I think that the possibility of rates staying higher for longer is very real, but it's not because of the inflation. It's because the Fed is using antiquated tools that don't adequately reflect what's really happening with the numbers. And I think they're getting it wrong. So, again, that's an opportunity for investors to buy companies that are growing faster than the rate of inflation itself.
So what are those companies, just briefly before we go? What categories of companies?
Well, most of them have been beat down mercilessly today in the last few days. It's going to be mainly the big tech. It's going to be some defense. It's going to be healthcare, anything that supposedly is interest rate sensitive, but in reality continues to have a very strong business consumer case.
Keith Fitz-Gerald, appreciate you walking us through it.